Welcome to Talk Tickers. Today we're breaking down Olin Corporation's wild Q4 earnings report. On the surface, the numbers looked like a total mixed bag. But by the end of the day, the market had made up its mind. So let's get into what exactly happened, and more importantly, why. Here's how we're going to tackle this. First, we'll hit the numbers that created all the confusion. Then, we'll get into management's side of the story, what they're calling trough conditions. After that, we'll look at how investors really felt about it. And we'll wrap up by looking ahead to the next quarter, giving you our rating, and even sketching out a potential trade idea. Let's do it. Okay, so right out of the gate, you can see the fundamental issue with this earnings report. The top line, your revenue, was telling a completely different story from the bottom line, which is your profit. And that is almost always a recipe for chaos on Wall Street. So just take a quick look. On the one hand, the revenue number looks pretty fantastic, right? Almost $1.7 billion, handily beating what analysts expected. But then you slide down to profitability, and the story completely flips. The main earnings metric, GAAP EPS, came in as a 75-cent loss per share. That's a big mess. Even when you adjust for one-time items, they just barely met the whisper number. And this, right here, is the central puzzle of the quarter. How on earth does a company beat its sales target by a pretty wide margin, yet somehow miss its profit target so badly? That was the big question hanging over the entire earnings call. So, how did the folks at Olin explain this? Well, they came to the call with a very clear, very specific story to tell, and it all boiled down to a single idea. They're in a trough. The CEO, Ken Lane, really tried to frame this as a victory in a tough situation. His whole point was, look, we know it's a down cycle, but despite that, the team focused on what it could control, and that meant generating cash and cutting costs. The message was simple. Yeah, it's tough out there, but we're weathering the storm at the bottom of the cycle. And when you dig in, they really painted a picture of a perfect storm. They blamed customer destocking, which means their clients are selling off inventory instead of buying new stuff. They also had some operational hiccups and supply chain problems. On the flip side, they talked up their Beyond 25 cost-cutting plan, promised their struggling epoxy business would be profitable again soon, and announced they're hiking prices on Winchester ammo to fight back against inflation. But then they dropped the bomb. The guidance for the next quarter. Management came right out and said that they expect profitability to be even lower than the weak quarter they just reported. For a market that was desperately looking for any sign that things had bottomed out, this was a massive red flag. So you have this messy picture, a revenue beat, a big profit miss, and some pretty grim guidance. How did the market sort all that out? Well, for a cyclical industrial company like Olin, it turns out one thing matters way more than anything else. And this chart right here tells the whole story. This is the heart of the problem. Adjusted EBITDA, it's just a key way to measure core profitability, absolutely collapsed. It went from almost $200 million a year ago to less than $68 million this quarter. We're not talking about a small dip here. That's like falling off a cliff. And that cliff dive in profitability, it led directly to this number. The stock got hammered, finishing the day down nearly 7%. The market didn't hesitate. The verdict was swift, and it was brutal. Which, of course, brings us right back to that head-scratcher. I'm sure you're thinking, wait a minute, sales were strong. Why did everyone freak out? Why didn't investors give Olin any credit for bringing in more money than expected? And here's the key takeaway. It all comes down to this. For a business like this that moves with the economic cycle, margins and the outlook for the future mean absolutely everything. Margins tell you if they have pricing power, and the outlook tells you where the business is headed. So when investors saw those profits getting crushed and heard that weak guidance, they just completely ignored the good sales number. For them, it was an easy sell signal. So what's the game plan from here? Where does Olin go from this point? Well, the entire story is now about one thing: execution. It's all about whether management's big turnaround plan can actually start to work. So, looking ahead to their next earnings call, here are the 3 things you absolutely need to watch. First, can they just do a little less bad than their own gloomy forecast? Second, will those Beyond 250 cost savings actually show up in the profit numbers in a real way? And finally, the big one for their Winchester brand. Do those price hikes stick, or do they have to roll them back? Taking all of that into account, we're kicking off our rating at market perform. Honestly, the story is just too balanced right now. On the one hand, you have the potential for a recovery and cost savings to lift the stock, but on the other hand, you have huge execution risk and really weak demand in the short term. So we think this stock is probably just going to move with the rest of the market until we get some real answers to those big questions. Okay, last thing, let's get a little speculative and put on our trading hats for a second. This is what we'd call a classic show me story, meaning the company has to prove itself. So, how could you actually trade a story like that? Well, here's one idea. You could call it the trough survivor trade. And the key here is you don't buy the stock today. No way. Instead, you wait and you watch for specific positive signs, these little green shoots. Step 1, you watch the pricing of their main chemical, caustic soda. You need to see that stabilize. Step 2, you find a way to verify that those Winchester price hikes are actually holding up in stores. And step 3, you have to wait for the next earnings report for hard proof that their cost savings are finally helping profits. And only if all 3 of those things line up, then you could think about buying, trying to catch the ride up as the market starts to believe in the turnaround. So there you have it, the complicated story of Olin's really tough quarter. A classic case of a solid revenue number getting totally overshadowed by a collapse in profit and a shaky outlook. And as always, please remember this is for informational purposes only. It is not financial advice.